appreciate your coming tonight. There's really only one thing I want to say about Chuck. As part of the due diligence process, I've actually looked at his brokerage statements, and I would encourage you to take a listen and see if you can't learn. He does a great job with his trading performance. His methods are very, very sound. They're based in fact. A very popular author out there in the industry, and it's a pleasure to have him here in the room today. So without further ado, Chuck, let's go ahead and have you turn back on the audio.
Good evening, everybody. This is Chuck Hughes. It's great to be here today. I want to talk first about what we're going to discuss tonight, and I want to present what I call my prime trade select process to select stock and option trades. And I'm going to show you the trade selection process I've been using for many years. I've been trading for over 28 years now. So I developed a basic trend following system many years ago that I still use today. So I've built additional indicators onto this basic trend system that I'm going to show you tonight. But I'm basically using the same trend system I used 28 years ago, and it's worked very well in all kinds of market conditions. So I'm also going to show you what I call high probability trades, and I'm going to show you how to discover these high probability trades using MetaStock. And as the name suggests, these trades don't come along very often, but when they do, they usually result in a very profitable trade. And I'll show you some actual high probability trades that I've taken. And just to give you some background on the prime trade select, I've had over $3.3 million in actual profits for my stock and option portfolios, and I'll show you the brokerage statements quickly that show this $3.3 million in profits using Prime Trade Select, which you're going to learn tonight. And I'm also going to show some spread strategies that do particularly well in volatile markets. And I use this in conjunction with my directional stock and option trade. So I have several different types of strategies that I use, and this allows me to generate consistent profits no matter what type of market cycle we're in. And at the end, I'd be glad to answer any questions. So just as a background, as I mentioned, I've been trading for more than 28 years. I've been using my basic trend following system for more than 20 years. And I just wanted to say that the last several years, 3 years or so, 4 years, have been very difficult markets to trade. There's been a lot of volatility and very little trend, and I'll show you some price graphs of the S&P 500 index just to demonstrate what I'm talking about here. But if you traded in the 1980s and the 1990s, we had these typical bull markets where the market would trend for months and months and years, and it was a lot easier to make money back then than it is today. But the strategies I'm showing you today, the trade selection strategy and the spread strategy, have been working well these last 3 or 4 years, as demonstrated by my real-time results. And we have managed to do very well despite these very difficult market conditions. Here's a price chart for the S&P 500 index, and you can see a lot of price volatility here, but the index is virtually unchanged over this time period. And Here's another price chart of the S&P, and this is in 2011, and we had 68 days in 2011 during which the S&P closed up or down more than 2%. So those are huge moves, and to have that type of a move, 68 days in a trading year, that's about 25% of all the trading days we had these huge moves. And you can see this price volatility in 2011, and yet the index was unchanged for the year. Started the year at 1257, ended the year at 1257. So despite all these volatile price moves, the index was unchanged, and this has become the new norm, where we get a lot of price volatility, but very little trend over the course of months or even years. Here's a price chart for 2010, same type of market where we have a lot of price volatility, and the index is virtually unchanged. Another snapshot in 2011, and again a lot of price volatility and index virtually unchanged. And again, here's that price chart for 2011. Started the year at 1257, ended the year at 1257. So if you were a directional trader during this 1 year period, whether you took long or short trades, it's very difficult to profit in these types of markets, which have become the new norm. So I rely on these strategies I'm going to show you tonight, and the real-time results show that that these strategies continue to work well despite these types of market conditions. Here's I took this snapshot in July of this year, and again a lot of price volatility over the previous 12 months, and the index virtually unchanged. So the financial concerns at home and abroad have played havoc with the stock market, and this is a price graph going back to 1998. So you can see the market really hasn't trended that well, and it's a lot of price volatility. And okay, I seem to have lost my display somehow. Let me see if I can get this back. Okay, here we go. And so it's very difficult for the stock market to trend when you have this type of chaos throughout the world. So the economic uncertainty has kept the market from really trending well like it used to. We got the Eurozone debt crisis that's entering its fourth year. We have the U.S. national debt that's topped $16 trillion, and most importantly, the U.S. and the global economic growth has been very anemic. So let's talk about Prime Trade Select, which is our trade selection process that I've been using for many years. And it's a three-step process. This is built into the MetaStock module, so these calculations are automatically done. And step one is to determine the price trend and the buying pressure for a stock. Step two is we want to confirm that price trend, and we want to determine the extent of the buying and selling pressure and isolate the very best trading opportunities. So on any given day, you're going to have hundreds of stocks that are in a price uptrend based on our trend following system, which you'll learn about here shortly. So the question becomes, if you have several hundred stocks that are on a buy signal, how do you narrow that list down to the stocks with the best profit potential? And I'm going to show you in step 2 how we narrow that list down by confirming the price trend. And step 3 is we want to select an optimum entry point, and this is a really important part of the process in these types of markets that we have right now, because you want to get a low risk entry so you don't get stopped out with the money management system. So whether you're buying a stock or an option, you want to get a good entry, and if you get a good entry, that'll increase your odds of success and increase the odds that you won't be stopped out. So this is an important part of the 3-step process. So let's look at step 1. We use trend following systems to determine the price trend, and in general, a trend following system quantitatively measures the buying and selling pressure of a stock. And when you use a trend following system, it allows us to follow the trend instead of trying to predict the price trend. And with the system, of course, it eliminates the emotional decision making, and so you move that emotional factor out of it, and a system is a system, and a stock is either a buy or a sell. So I use daily price charts to determine the price trend of a stock. Here's a daily price trend for Apple, and these vertical bars, of course, represent the daily price movement of Apple stock for that day. And here's the column to the right hand side has the price. And here's a price chart, daily price chart of Apple, and we also have the 50-day exponential moving average, which is this line right here. So my basic trend following system is pretty simple. I use the 50-day exponential moving average in relation to the 100-day exponential moving average. And if the 50-day exponential moving average, which is the shorter of the two averages, if that 50-day EMA is above the 100-day EMA, then the stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, the stock is on a sell signal. Now here's a price chart, daily price chart for Apple stock. You can see the daily price movement here, and this blue line right here is the 50-day exponential moving average, and the red line is the 100-day exponential moving average. Now you can see right here in April that the 50-day exponential moving average crossed above the 100-day exponential moving average, so that created a buy signal for Apple right at this point right here. And as long as that 50-day EMA, which is this blue line, as long as that's above the 100-day EMA, then Apple remains on a buy signal. So the system's pretty simple, and when you look at a chart, a price chart, you know right away whether that stock is a buy or a sell. And we can see with the 50-day EMA above the 100-day EMA that in this time frame Apple was on a buy signal. Now here's an example of a sell signal, and we can see right here the 50-day EMA, the blue line, crossed below the 100-day EMA, and this is for Merck stock. So as soon as that 50-day crossed below the 100-day, Merck stock was on a sell signal, and as long as that 50-day remained below the 100-day, then the stock is on a sell. And when you get these moving average crossovers, you never know how long the trend is going to last. So if you owned Merck stock at this point, you'd probably want to sell some of your stock, start exiting your long positions, because you don't really know how long this downtrend is going to last or how severe it's going to be. So that's one of the advantages of using a system. You don't have to try to guess which way it's going to go. If the 50-day drops below the 100-day, then it's on a sell signal, and until the 50-day crosses back above the 100-day. So that's one of the advantages of a system. You just look at a price chart, you know right away whether this stock's in a buy or a sell. So let's look at the type of trades that we take. If the 50 days above the 100-day and the stock's on a buy signal, we want to take bullish trades, and we purchase stocks and we purchase ETFs. We purchase call options, which is a bullish strategy, and we also purchase bullish option spreads. And if the 50 100-day EMA system is on a sell signal, then we want to take bearish trades, and we can purchase put options, we can purchase bearish option spreads, and we can also purchase bearish ETFs. And I just wanted to mention that I only take what I call limited risk trades, and what that means is with all these trades that are listed here, whether they're bullish or bearish, your risk is limited to the amount of money that you invested. And a lot of times this really doesn't make a lot of difference, but sometimes if you have an unlimited risk trade on, sometimes world events overnight or news about a stock can cause you to get forced out of your position, and you could wind up with a margin call. It doesn't happen that often, but it only has to happen once, and your trading account's wiped out. So I like to just take the limited risk trades where my risk is limited to my investment, whether it's a option spread or purchasing a put option instead of being short naked options. So now, because the 50 and 100-day EMA system is a mechanical system with buy and sell rules, I was able to do historical testing, and I did this over a 24-year period. And if the 50-day EMA crossed above the 100-day EMA at the start of the test, then we bought the stock. And then once the 50-day EMA crossed below the 100-day, then we sold the stock. So the software kept track of the historical profit results, and this test assumed that I bought 100 shares of the stock at the beginning of at the first buy signal at the beginning of the test period, and then compounded the results. So here's in this left column here, I listed the stocks that were tested, and in this column right here lists the cost to buy 100 shares of these stocks when the first buy signal occurred. So to buy 100 shares of the stocks listed in this left-hand column, it took $8,204. So over the course of that 24-year period, that $8,204 cost produced over $210,000 in profits. So that equated to a 2,567% return, or just a little over 100% a year over that test period with the 50 and 100-day EMA system. And the profit factor was 12.7. So that's a general measure of risk. So for each dollar that the system lost, it made over $12. So what that indicates is that the system normally gets you out of a losing trade before that losing trade develops into a big losing trade. And as I mentioned, I've been using my basic trend following system for many years. And when I started out trading, I was trading stock options, and at the time I could only come up with $4,600. So I started my trading career with a $4,600 trading account, and within my first 2 years, I made over $460,000 in profits, and that was more than I had made the previous 6 years as an airline pilot. So this trading, which was my hobby, eventually became my main source of income. But just starting out with a $4,600 account, I was able to make over $460,000 in profits, and these are copies of my tax returns those first 2 years when I started my trading. And the first year I made over $69,000, and second year over $391,000. So these my basic trend following system's been working well for many years. And I also have entered the international trading competition, and that's a real-time trading contest where the contestants trade real money. And this table just lists the years that I won first place, and then I also had some second and third place finishes. So I'm just showing you, I'm not trying to brag, I'm just showing you this so that you know that the trend following systems work, because I use these basic systems to win these contests. Okay, step 2 of our prime trade select is we want to confirm the price trend. So if we see a stock and the 50-day exponential moving average is above the 100-day, and that stock is on a buy signal, the next step is we want to confirm that uptrend, price uptrend. And one of the indicators I use is on balance volume. And on balance volume measures the volume flow with a simple line, and the volume flow precedes the price movement, and also the volume flow helps sustain the trend. So this is a valuable confirmation indicator. And the way this on balance volume line is calculated is when a stock closes up for the day, volume is added to the line. When a stock closes down for the day, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the on balance volume line. And here's a price chart for Apple, and on the top part of the chart we have the daily price movement of Apple, and in the lower chart here we have the on balance volume line, which is this line right here. And with the on balance volume line, the actual numerical value of the indicator is not that important. What's important is that you just want to see this line sloping up. And if this line is sloping up, then it confirms this price uptrend that we have for Apple stock, and it means that the volume flow is bullish and is supporting that price uptrend. So when we have that upsloping on balance volume line, volume's heavier on days that a stock closes up, volume's lighter on the day the stock closes down, and that's an indication that the buying pressure is exceeding the selling pressure, and this volume flow helps sustain the price uptrend. And another confirming indicator I like to use is the new 52-week high list. And stocks that are making a new 52-week high are in a very powerful uptrend, and they tend to continue their upward price movement. And in my experience, I discovered that these stocks that are making a new 52-week high, they tend to continue their price uptrend. And if they're making a new high, that confirms the price uptrend, and that allows us to further narrow down our buy list to those stocks with the greatest profit potential. So the stocks that are included in that new daily 52-week high list, they represent the very best profit opportunities available out of the universe of more than 6,000 common stocks. So plain and simple, the stock does not make this list unless it's in a very powerful uptrend. So that's one of the indicators I like to use to confirm the price trend. So let's look at another price chart of Apple. We can see the daily price movement here. We can see the 50-day EMA above the 100-day. We can see that we have an upsloping on balance volume line, which confirms this price trend. And then we can also see that Apple stock is making a series of new 52-week highs, which also confirms the price trend. So the MetaStock software will screen for stocks if the stock, first of all, is on a buy signal and the 50-day EMA is above the 100-day EMA, and it looks for stocks that have traded at a new 52-week high in the past 4 weeks, and it'll also screen for stocks that have an on-balance volume line that is greater than it was 6 months ago. So the MetaStock software first determines the price trend, and then we use these two confirming indicators to signal a buy signal for a stock. This is just a sample of the new 52-week high list, and of course the number of stocks on this list is going to vary every day depending on the market conditions, but usually the stocks on this list are really worth looking at, and they represent your best profit opportunities out of all the stocks out there. And so here's an example for the Prime Trade Select, and I believe this one, this is a price chart for Discover Financial, and this is just an example of a stock that's on a buy signal on using the Prime Trade Select system. And this price chart, I think, was taken yesterday or the day before. So this is a current price chart just demonstrating a stock that's on a buy signal, and we can see Discover's been making a series of new 52-week highs. The 50-day EMA is above the 100-day EMA, and we have an upsloping on balance volume line. Here's another example. This is for Home Depot, and again we can see the daily price movement here. We can see Home Depot's been making a series of new 52-week highs. The 50-day EMA is above the 100-day EMA, and we have an upsloping on balance volume line confirming this price uptrend. And here's one more current example. This is for Visa, the credit card company, and again we have Visa making a series of new 52-week highs, and we have an upsloping on balance volume line confirming this price uptrend. So these are three current examples of stocks that are on a buy signal. And The third step in prime trade select is to select an optimum entry point using the Keltner channels. And the Keltner channels, they're basically overbought, oversold indicators, and they're one of the simplest but most effective timing indicators. They were originally developed by Chester Keltner and updated by Linda Raschke in the 1980s. And these Keltner channels are very useful. They can be used to help time your trade entry and exit points for a stock or an option trade. And they also produce what I call high probability buy and sell signals, and I'll show you some examples of that here shortly. And we can also use the Keltner channels to help us select option strike prices, and also I use these to select stocks with repetitive and predictive price patterns, and I'll show you some examples of that too. So here's a price chart with the Keltner channels, and we can see the daily price movement of Apple stock here, which are these vertical bars, and then we have an upper band, an upper channel, which is this line right here. We have a middle channel, which is the dotted line, and then we have a lower channel. So there's three channels that are displayed when you're looking at the Keltner channels. And the central or middle channel, which is this dotted line right here, that is the 20-day exponential moving average for a stock. So this dotted line is the 20-day exponential moving average, and the upper and lower channels are 2 times the average true range of the stock over the past 10 days, and they're drawn at equal distance points from the middle channel. So the upper and lower channels are 2 times the average true range of the past 10 days. So the Keltner channels act as an overbought, oversold indicator. This is a price chart for U.S. steel, and the way we use these Keltner channels is we don't want to buy when the stock is up near the upper channel, because that's an indication that the stock's getting overbought. We want to buy when the price of the stock is trading near the middle or the lower channel, when the stock becomes oversold, and that can give us a better entry point. So here's another price chart. This is for Apple, and again, the idea of an oversold, overbought indicator is when the stock's trading up near this Keltner, or when it's trading up near the upper channel, the stock's getting overbought. So you don't want to buy when it's trading above this upper channel. You want to wait till it becomes oversold and trades down near the middle or the lower channel. And you can see in this price chart, when Apple stock got above the upper channel, it became overbought, and then it usually retraces back down. So you can see overbought, retraces back down, overbought, retraces back down. So very useful tool for entering trades. And in this price chart, what I did was I listed my brokerage transactions here that show me buying Apple stock, and it has the date and the number of shares and the price that I purchased the stock. And what I did in this lower price chart is I indicated these days up here. In other words, on these days when I purchased Apple, I annotated this on the chart, and you can see my first entry here. It was when Apple stock was trading near the middle to lower channel, and my second buy again was near the lower channel, and my third buy here was near the middle channel. So I was using the Keltner channels as a timing tool to enter these positions with Apple stock. So these are my actual trades right here, and you can see at these various buy points, Apple stock did not retrace very much after I bought it. So that's the beauty of using this as a timing indicator. It can help you find a low risk entry, and you want to buy the stock when it's getting oversold, and this increases your chance of success and the probability that your trade's going to be successful. So you want to wait till the stock gets oversold, and you can see in these three buy points, actual buy points here for the stock, that the stock really didn't retrace very much after I had bought it. And another use of the Keltner channels is it allows you to focus on stocks that have a repetitive and predictive price pattern. And this upper price chart here is for Mosaic stock, and you can see a lot of price volatility, but the price movement doesn't really indicate one way or another which way the stock's going next. Whereas the lower price chart is for TJX, and you can see that TJX, the price pattern's been very repetitive and very predictive. So I'd much rather focus on a stock like TJX than Mosaic, which you have no idea where it's going next. So that's another advantage of these Keltner channels in helping us select our trades. Here's another example. This upper price chart is for Sherwin-Williams, and again you can see very repetitive and very predictive price movement. And the lower chart is Freeport-McMoRan, and really no clear price patterns here, and you don't know which way the stock is going to trade next. So again, I like to focus on this type of a stock. Here's another example. This is for Disney. Upper price chart is for Disney, and the lower one is for potash. So this allows these Keltner channels allow you to focus on stocks that are somewhat more predictive in their price patterns. So the MetaStock Prime Trade Select program, it screens for stocks that have the 50-day EMA above the 100-day EMA. The stock is traded at a new 52-week high in the last 4 weeks, and the on-balance volume is greater than it was 6 months ago. And then it looks to buy a stock if it declines to that middle Keltner channel or below. And I just want to discuss briefly what I call high probability signals, and these occur when a stock gets very oversold, and when that happens, the stock will actually close below this lower channel. And when that occurs, it doesn't happen that often, but when it does, the stock is getting very oversold, and usually there's a very strong rally that follows this oversold condition. Now, this is in the context of the stock being in a price uptrend according to the 50 and 100-day EMA. So we're looking for stocks that are in a price uptrend, but become temporarily oversold, very oversold, and actually close below this lower channel. And that usually sets up for what I call a high probability signal in a strong rally. And what I did is I listed some of my brokerage confirmations up here. This was buying Apple stock right here when it actually closed below the lower channel. So I bought 50 shares here, 50 shares, 100 shares, 100 shares, and that's right at this point. And this was around the 333 price range on Apple. So Apple's gone on and has rallied pretty nicely since I made these buy points at around the 333 level when Apple stock was on a high probability buy signal. And the last 5 signals, high probability signals for Apple, produced an average rally of 81%. So when the stock gets really oversold and actually closes below this lower Keltner channel, those last 5 high probability signals produced an average rally of about 81%. Here's another example. This is for Baidu, and we can see Baidu became oversold here, actually closed below this lower channel. At the time, Baidu stock was on a price uptrend. The 50-day EMA was above the 100-day, and when it traded right here at around the $98 level, I went ahead and bought 200 shares of Baidu at 98. So just another example of taking advantage of these high probability signals and picking up stock when it becomes oversold. Here's another one. This is for the NASDAQ ETF. Became oversold right here. So I went ahead and purchased the NASDAQ ETF. Here's another example. The S&P ETF becomes oversold. So I went ahead and purchased shares when it was trading right in this range right here. So here's a few more examples. This is for Chevron, and it became oversold right here, and then you can see it had very strong rally following that oversold condition. That was about a 45% rally. Here's another one for Caterpillar. Became oversold, actually closed below the lower channel, and then this produced about an 80% rally in the stock. Here's another one for Tesoro. Becomes oversold, and then a very strong rally follows. Okay, again, just to recap with the here's the MetaStock high probability signal, and our MetaStock rules to generate these high probability signals are, of course, the 50-day EMA is above the 100-day. The stock's traded a new 52-week high in the last 8 weeks, and then on-balance volume is greater than it was 6 months ago. So if that happens, the MetaStock, if the stock actually closes below the lower channel, then it qualifies as a high probability signal. So this text right here is not correct. It says buy the stock if it declines to the middle channel. But no, the high probability signal for MetaStock is if the stock closes below the lower Keltner channel, then that will qualify it for a high probability signal. So we have to get that corrected. So just to give you an idea of the real-time results for Prime Trade Select, it's generated over $3.3 million in actual profits over the last 3 years, and 1.5 million of that was profits that I had in stocks, and 1.8 million was profits that I had in options. So if the stock qualifies as a prime trade select buy, then we can buy call options, and if the stock qualifies as a prime trade select sell, then we can purchase put options. So these are my real-time results using prime trade select. The stocks, I had over $1.5 million in profits. Average return was 28.9%. 113 winning trades and no losing trades. With the options, 1.8 million in profits, average return of 85%. 183 wins, 17 losers, 91% accuracy. And what I'm going to do is just show you my stock trades first, and then we'll look at the option trades. And this was a recent snapshot of my stock portfolio, and I trade that in two different retirement accounts. So my first retirement account, which is a defined benefit plan, I had $272,000 in profits, and in my second retirement plan I had $146,000 in profits. So just recently I've had over $400,000 in profits in my stock portfolios using Prime Trade Select. Now here's some more snapshots of my stock portfolios, and these profits totaled, as I mentioned, over $1.5 million over the last 3 years. So I'll just run through these stock portfolios pretty quickly here just to see the actual trades. Okay, and now I'm going to just take you through the option profits. And again, these option trades, there was over 1.8 million in profits and an average return of 85%. So I'll just run through these option trades here quickly, and you can see the actual trade results for Prime Trade Select. Okay, so I want to talk here briefly about another strategy that I use, and this is a spread strategy, and this has also been doing very well in these volatile type markets. And this strategy is trading weekly covered calls, and this is a pretty easy strategy to implement. You buy 100 shares of a stock or an ETF, and then you sell a weekly call option against these 100 shares. So this is a spread strategy, and with this strategy you generate weekly income by selling these weekly call options, and you get to do that 52 times a year. So the profits in this strategy can really add up, and it doesn't really matter which way the market's going, and you can still be profitable, whether the market's going up or down. And I'll show you some examples of that, of the trades I have on right now. So if you're not familiar with this general concept of selling option premium, when you sell option premium, cash is immediately credited to your brokerage account. So if you're selling weekly call options, you're going to collect this cash premium every week, and that's cash that goes right into your brokerage account. So if you sell an option that has 4 points of premium, then $400 in cash is immediately credited to your brokerage account. And this cash credit reduces the cost basis of the stock and reduces the overall risk of the trade. and selling these weekly options allows you to compound your returns very quickly. So selling these weekly call options, that can lead to a 100% cash on cash return regardless of the price movement of the underlying stock, and I'll show you an example of that. So if you invest $4,000, you could receive up to $4,000 in cash income over the course of the year, regardless of the price movement of the underlying stock or ETF. And these weekly covered calls have been very profitable in every type of market condition, and of course they incur less risk than owning a stock or an ETF. So the weekly options, they start trading on Thursday and they expire the following Friday, so they have a life of 6 trading days. So very short-term options, but that's a big advantage. If you're selling option premium, you want that to expire as quickly as possible, because when the option expires, that's when it becomes profit. And with weekly options, you get 52 opportunities each year to sell this option premium, and this allows you to roll over your profits and compound your returns really quickly. So over the last 3 years, my covered call trades have generated over $1.1 million in actual profits, and I'll show you those brokerage statements real quick. And these last 3 years have been very volatile, and for the most part, the market really hasn't been trending. And if you recall those S&P 500 index price charts I showed you at the beginning of the presentation, that's the new norm, and this strategy does well in that type of environment. And with covered calls, I also I generated over $7 million in gross option premium income over the past 5 years. So I have copies of these brokerage account confirmations showing these trades that generated this $7 million in gross option premium income. So over the past 5 years, these brokerage account statements that are in my U.S. Money Strategies book show this $7 million in cash that was credited to my brokerage accounts. So this averages out to more than $124,000 in cash income per month. So I've been real active with selling this option premium, and I didn't start trading the weekly options till 2010. They weren't available until 2010. So prior to that, I would sell option premium on monthly options, but now these weeklies that you can sell every month, this makes this whole strategy much more profitable. And I just wanted another real-time result I had trading these covered calls was I won the 2009 trading competition, and I was trading covered calls in that account, and I'll show you one of my account statements from 2009 when I won this competition. So I started with a $100,000 balance, and by the end of the year I had $122,000 in profit. So I had a 122% annual return in 2009, and this was this was a real money contest. So these results, they were audited before they were published on the website. So there's no fudging these results. These are all audited before the sponsor publishes on the website. So 2009 made 122% trading these covered calls. And part of the reason why I was able to do that is I was rolling over and compounding my returns. And I'll show you how to do that. And I've made as much as $68,000 in profits over a 1 month period this year with these weekly covered calls. And I'll show you my brokerage statements that show this $68,000 in profits over a 1 month period. So this strategy has been working well in this new norm where we have a lot of price volatility and very little trend. So just some basics on selling option premium. Options consist of time value and intrinsic value. And if you sell an at the money or out of the money call, it consists of only time value. So I normally sell at the money calls with these weekly covered calls. So at option expiration, options lose all their time value. So if you're short an option, that time value portion of that option becomes profit at option expiration, regardless of the price movement of the underlying stock. So that's the basic concept behind selling these weekly covered calls. They expire in a week, and when they expire, they lose all their time value. So if you're short an option, that time value portion of the option becomes profit at option expiration because the time value decays to zero. So that's the basic concept behind this strategy. And I took a recent snapshot of a weekly covered call trade I made. Now, what I do is when I'm trading these weekly covered calls, I'll just hold the stock or the ETF, and then I'll close out that weekly option every Friday and then roll it over to the next option. But I generally like to keep the underlying stock or ETF in my account, and I'll close out the expiring option and then roll that over to the new option. So this is an online brokerage account. This is a trade that I did. This is a rollover trade, and this was an actual trade I took. I owned the TNA, which is a leveraged small cap ETF. So I own the TNA ETF, and each week I will close out the expiring option and then roll it over to the new one. So this shows an actual brokerage account order that I entered. This was about 10, maybe 2 weeks ago, and I bought to close the November 23rd weekly call, and then I sold to open the November 30th weekly call. Now I have since rolled over this November 30th to the December 7th, and tomorrow I'll roll over the December 7th to the December 14th. So each Friday I roll over these options, and that allows me to compound my returns. So in this order, I was buying to close the November 23rd 52 strike call, and then I was selling to open the November 30th 54.5 call. And that 54.5 call was trading, the bid was 140, the ask was 145. I put this in a limit order, and I got filled at 142. So just make a note, the TNA, when I entered this order, was trading at 54.27, and I was selling the 54.5. So this was slightly out of the money. So this premium, bid 140, ask 145, that was all time value. So here's my confirmation, and I went ahead and sold short the 54.5 call at 142. I get filled about midway between the bid and ask price. So sold 8 of these 54.5 strike calls at 142, and of course they were slightly out of the money, so that was all time value. So again, this time value, or this 1.42 points, was all time value, and that decays to zero in a week. So that becomes profit in 1 week when that time decay, when the time value portion decays to zero. So if you were to enter this covered call trade, now of course I already owned the ETF, so I didn't buy the ETF in this trade. I simply rolled over the options. But let's assume you were to buy the TNA. You saw it was trading there at 54.27 minus the 142 option premium I collected. So your cost for this covered call would have been 52.85 times 100. So this is a $5,285 investment. Now, I sold the 54.5 strike call at 142, so $142 in cash was credited to my brokerage account. So let's take a look at the possibilities, the potential for this trade if you do this 52 weeks a year, which I do. And you can see if you were to collect a similar premium, and let's just assume you collected a similar premium, so 142, if you did that 52 times a year, you're going to collect over $7,000 in time value option premium, which again becomes profit at option expiration. And so we saw where the initial cost was $52.85, and you're going to collect over $7,000 in cash. So this has the potential to generate 139% cash on cash return over the course of a year. So even if this ETF declines 20 or even 40%, you can still profit with this strategy. So again, your initial investment $52.85, and you have the potential to collect $7,300 in cash with this strategy. So that's why these weekly options are so lucrative, because if you're collecting that kind of cash on cash return, a lot can go wrong with this trade, and I'm still going to profit. As we mentioned, the underlying stock or ETF could decline substantially, and you're still going to profit. If you had bad timing on when you entered the trade, you could still profit. And there could be volatile price swings with that ETF, and you would still profit, because you wouldn't be getting stopped out like you normally would if you were implementing your money management rules and you just purchased this ETF. You may get stopped out during these volatile price swings. So when you're selling these weekly covered calls, though, if you just hold it and you're collecting 139% cash on cash return, you can just hold that trade through these volatile price swings. And that's been really important the last 3 or 4 years. So this gives the weekly covered call strategy a huge advantage over stock or option directional trades that only profit if the stock or ETF moves in the right direction. So a great strategy for current market conditions. And as I mentioned, if you roll over these options each week, and let's assume you collected this $7,300 in cash, you can purchase more shares of the ETF and then sell more call options. So you can do additional covered calls, and this allows you to compound your returns. So I'm going to just show you a couple snapshots here of my brokerage transaction histories, and these show the cash on this column right here that was credited to my brokerage account, and this was over the course of 1 week. In other words, this first one was selling Apple weekly calls, the financial ETF weekly calls, and so on. So this shows the amount of cash that was credited to my brokerage account, and this was over a 1 week period. So this week I collected $13,500 in cash. Here's another example of a 1 week period, and again, in this column right here, it lists the cash that was credited to my brokerage account. This week I had over $16,000 in cash credited to my brokerage account. Here's another example. This week I had $28,000 in cash credit to my brokerage account. So you can see these weekly selling this weekly time premium can really add up to a lot of income. And now if I was to take that $16,000 that I received in cash income and I did that 52 weeks a year, then then I'm collecting over $834,000 in potential time premium profits over the next year. So this year we've had periods where we had a lot of price volatility, and we had big upswings and downswings in the market. So what I do is, as soon as I sell a call option, I'll go ahead and put an order in to buy back that option when it reaches 85% of its profit potential. And what that allows you to do, if the market takes a dip and you buy back that short call option, then you can go ahead and sell another one. And I call that double dipping. So a lot of times in these volatile price swings, you'll buy back that short call and then sell another one, and you're actually selling two premiums in 1 week. And I did this last week. I just had these orders sitting in there. The market took a dip, and for most of my short call options, I was able to buy those back and then sell another option and collect two premiums inside of a 1 week period. So regardless of the market conditions, you can sell this premium 52 weeks a year and collect up to a 100% or more cash on cash return. So this type of strategy can profit in any type of market. And what I'm showing you here is an example of double dipping. I showed you this one when I collected $16,000 in premium that week. Now what happened was the market dipped that week, and these confirmations show that I bought back a lot of those short options I bought to cover. So it cost me about I sold $16,000 in premium, and after just a day or two I was able to buy back a lot of these options, and that cost me about $1,000 to buy it back. But then I collected additional $6,600 that week. So that was $6,600 plus $16,000, and I was able to do that because I was double dipping and closed out the short calls when they didn't have much premium left. So you can profit even during market corrections with the double dipping, and I've even had weeks where I sold three premiums in 1 week. Now, as I mentioned, I like to roll over the options, and when you roll over, it allows you to reduce the transaction costs. It reduces your brokerage commissions, and also if you use a spread order, you can put the order in halfway between the bid and ask on the option, and sometimes that can save you on the bid-ask cost of the option trades, and of course on the brokerage commission. And then when you roll over, it allows you to purchase more shares of stock and then eventually do more covered call trades. And these are just examples of spread orders I use to close out the expiring option. In this example, this was for an Apple weekly covered call, bought to close the February 24th 505 strike call, and then sold to open the March 2nd 525 call. So what I did is I put put a limit order in halfway between this bid and ask, and you can save on the, I normally get filled if I put the order in midway between the bid and ask price. So you save not only in the commission, but you save on the bid ask price. And here's another example. This was for the emerging market index. I was rolling over. I just kept the ETF, and then I rolled over the weekly options. I bought to close the February 24th, sold to open the March 2nd. And here's the reason why these weekly covered calls are so lucrative compared to the monthlies. This is an option chain for Apple, and Apple at the time was trading at 585. So the at the money call would have been the 585 strike. So the this shows the price, the premium for the 1 week call. This had 7 days to expiration. The premium was 1405. Now the monthly premium was 2830, but of course the monthly premium is higher. It's 2830 versus 1405, but I get to sell 5 weeklies over this same time period where I'm selling the monthly, because they had 36 days to expiration. So if you were to get a similar premium and you sold 5 of these weeklies, you'd collect over 70 points of premium versus 28 points for the monthly option over the same time period. So that's why these weekly options are so lucrative when you're selling option premium. Here's an example for MasterCard, and I get to sell 12 of the weeklies at 1190, which would produce about 142 points of premium versus 23.5 points over the same time period. So again, these weeklies generate a lot more premium over the same period of time compared to monthlies. So here's I'm going to show you snapshots here real quick. This was a 1 month period that I traded weekly covered calls, and over this 1 month period I had over $68,000 in profits. These are closed out profits here. I'll just run through this real quick. So this was a good month for me. I had over $68,000 in profits, and I'm going to run through my brokerage account statements for the last 3 years, and these show over $1.1 million in real-time profits. And of this 1.1 million, 915,000 of this were weekly covered calls. In other words, when I in 2009 these weekly options weren't available, so some of these results are based on monthly options, but you can see most of it is based on the weekly covered calls. And that, they've generated a pretty good return over the last 3 years despite the difficult market. So I'll just run through these weekly covered call profits here, and I have an interesting comparison here at the end that I want to show you. And here's this is a snapshot of my 2009 trading contest account. I think I mentioned this, and that year I had 122% from trading covered calls. And now in 2009, these were monthly covered calls, but I used the same principle where I would roll over the option monthly, and then that enabled me to compound my return. So that's a pretty good return for trading covered calls. So that was 2009. Here's a snapshot, 2011 weekly calls, and in this account I had $323,000 in profits, average return of 54%. And here's a snapshot from 2012, and this is in 2 different accounts, and I had $332,000 in profits, average return of 36%. So this was in two accounts. So this was the stock portion of it, and here's the weekly options, and here's the second account. So again, this was a $323,000 profit this year. So now let's just compare. This is my last slide. Let's compare how much money it takes to generate $50,000 of yearly income in CDs versus this weekly covered call strategy. So let's assume you want to generate $50,000 a year in income, and if you were to split your money evenly between the 1-year CDs and the 5-year CDs, it would take over $6.7 million to generate $50,000 in yearly income. Now, granted, this is a guaranteed return with no risk, but not a lot of people have $6.7 million available to generate $50,000 in yearly income. So let's assume that you were trading these weekly covered calls and you were able to produce a 33% yearly return, which I think is totally reasonable. You saw where in 2009 I had a 122% return. 2012 I had a 54% return, or 2011 I had a 36% return. So this 33% assumption is not outlandish. In other words, it's realistic to assume that you could get this 33.3% return based on 2009, 2010, and 2012 results that I had. So if you're able to get a 33.3%, it would only take $150,000 in a $150,000 investment to generate this $50,000 in yearly income. So I thought that was an interesting comparison. $6.7 million versus $150,000 to generate $50,000 in income. So that concludes my presentation, and I have an advisory service where we trade these weekly covered calls along with other strategies. And if you want to look at our current profit results, just log on to weeklyoptionalert.com and then click this trade results page, and we have the current trade results. Or you can call Brad toll free at this number, and if you're interested in this weekly option advisory. So I want to thank everybody for attending, and it was great to be here tonight, and I'd like to answer any questions that you may have.
Okay, we did have a few questions that came in that I wrote down, and if you still have questions, go ahead and ask them. Earlier, when you're showing the AT, I can hear myself, it's weird. When you're showing the ATR strategy earlier, when it was a buy below the ATR, the question Derek had, I believe, was do you have stops in place when you take that strategy?
Yes. If we're using the prime trade select and the stock is in a price uptrend, but then it becomes temporarily oversold and it traces back below that middle channel, which is the 20-day ATR, then, or I believe that's the 10-day ATR. Yeah, it's the 20-day EMA is the actual dotted line, and then, yeah, that's right. The dotted line is the 20-day EMA. So if the stock is in a price uptrend, but it temporarily declines to that 20-day EMA or below, and you buy it, then you always use a protective stop. And I like to exit a stock trade if it declines 10 to 15% below my entry price as part of my money management um, guidelines.
And Ed asked, how many different advisory services do you run?
I have the weekly option advisory, and then I have my inner circle advisory. And the inner circle is longer term positions, but I trade stocks and options and option spreads and covered calls. And the weekly, then I have the weekly option alert, and that has a shorter term focus than the inner circle.
Derek asks, when you made the $68K in monthly profit in weekly cover calls, was this from premium or growth in the underlying stock as well? And then he also asked, what was your total investment?
Yeah, that $68,000 that month, I'm not really sure what my total investment was. I didn't really add that up, but that was showing closed trades. In other words, those were trades that I closed out over a 1 month period, and they were showing the profit on the short option. So what I did is I just did a scan in my brokerage account and looked at the closed trades, option trades for that month, and that was from closing out the short option.
Oh, David asked a really good question. Do you enter your stops in as an order, or do you watch the price, afraid somebody's going to grab you?
That's a good question. With my protective stops, that's always market on close. So I'll watch the market, and if it looks like it's going to close below the stop, then I exit.
Okay. Oh, more questions. Derek asks, if you're called out on your weekly options, do you buy the stock back for the next week's play? Or do you always roll to the next week? Okay. The answer is yes.
Yes, the answer is yes. If I get called out, now, I've only, this year, even though I've been very active, I seem to recall I was only called out once or twice this year. And what I did was I just simply said thank you, and I bought the stock back and did another covered call.
I've been rolling positions in covered calls portfolio for a couple of months. I'm in a loss position. Have you had this experience? Would I expect to see profits if I consistently roll over calls each week?
Yes, I would say if you consistently do that and you collect those time premiums every week, that you will be profitable. And of course, a lot of that's based on your timing. Sometimes if you enter these covered call trades just as the market is trending down, then it may take longer. But yes, if you sell this premium every week, you should generate enough income to be profitable.
Okay. All right. Well, I think with that,
all right,
we're going to go ahead and wrap up tonight. Chuck, we appreciate having you in here. A lot of the comments that we've had are really extremely profitable. It's rare for us to get somebody that's actually willing to come in and show their trade reports and their trade results, and it definitely added a lot of credibility. We appreciate you having you in here today.
Okay, well, thanks for having me, Jeff, and thank you, everyone. It was great.
Go ahead. Sorry.
Yeah, it was great being here tonight, and I hope everybody has a great evening.